Hello, and you're welcome to Global Business Insights, where we look at the headlines from a deeper business perspective. Nigeria's annual inflation rate dropped to a 6-month low at 33.2% in August, offering the central bank monetary policy a window to halt an unprecedented tightening cycle when they meet next week. The U.S. Empire State Manufacturing Survey conducted by the Federal Reserve Bank of New York, which gauges business conditions for New York manufacturers, showed the index at 11.5, exceeding estimates. The 6-month outlook for overall activity increased to the highest level since March 2022, also signaling that producers are more upbeat about the economy's prospects. Former President Donald Trump is safe after his Secret Service detail opened fire at a man with an assault rifle at his West Palm Beach, Florida. That's a golf course in what the Federal Bureau of Investigation is calling an assassination attempt. The rhetoric from both sides and often contentious style in coverage of the elections need to be toned down. The gun culture definitely also a problem. The Bank of England is widely expected to leave interest rates on hold on Thursday's MPC meeting, Monetary Policy Committee meeting. On Thursday, we also get U.S. weekly initial jobless claims, followed by the Federal Manufacturing Index data. Like the Bank of England, the Bank of Japan on Friday will hold its policy rate at 0.25%. BP is selling its onshore wind business in the U.S., offering up 10 wind farms across 7 states that may be worth upwards of $2 billion. BP says its wind farms are all operating with customers and connected to the grid with a total combined capacity of 1.3 gigawatts. Nigeria's headline inflation slowed down to 32.2% in August 2024 for the second month, and also the lowest read in 6 months, down from 33.4% in July. Food inflation was down to 37.5% in August from 39.5% in July due to higher yields and the 6-month duty-free window for corn and wheat imports. But core inflation, which excludes agricultural produce and energy, rose to 27.6% from 27.5% in the previous month. On a monthly basis, consumer prices increased by 2.22% in August compared to a 2.28% rise in the prior month. On a month-on-month basis, the core inflation rate was 2.27% in August, higher than 2.16% in July. Sticky core inflation was due to high rents, transport, accommodation, and medical services. The slowdown in inflation does raise the possibility that the Monetary Policy Committee could pause a tightening cycle as it announces its decision. That's next week, September 24. The MPC has lifted the benchmark rate to 26.75% from 11.5% in just over 2 years, and may need time to assess the impact of recent currency volatility, devastating floods in northeastern Nigeria, and the increase in gasoline prices on inflation. Still, if we do get a rate increase from the MPC, given higher core inflation, it more likely will be a lower basis points increase than prior rate adjustments. Recently, it was reported that Katsina State Governor, that's in Nigeria, Dikko Rada, approved over 340 million naira to restore electricity supply to the state-owned University Umaru Musa Yar'Adua University, Katsina, enabling the institution to resume after extending its mid-semester break. Still on electricity issues in Nigeria, the federal government is expected to pay about 180.8 billion naira as electricity subsidy for power consumers from bands B to E that have had their tariffs frozen since December 2022. We look at the issues facing Nigeria's much challenged electricity sector, with Toyin Abiola-Salami, partner, audit services, KPMG West Africa, and an expert in the electricity sector, speaking to some of the issues.
Nigeria's power sector, despite its potential, faces several significant challenges. We have an installed generation capacity of around 18,000 megawatts. However, sadly, only about 4,000 to 5,000 megawatts is reliably distributed due to frequent outages and outdated infrastructure. In comparison, South Africa, with its ESCOM utility, has a generation capacity of approximately 45,000 megawatts. Despite the issues in South Africa, the infrastructure and generation are a lot more stable, which allows for better reliability and coverage. According to the World Bank, 55%, only 55% of Nigerians have access to electricity. Yet this access is often unreliable and it affects our productivity and our daily life. By contrast, South Africa has near universal electricity access due to more consistent infrastructure investment and maintenance. So what are the challenges? Why can't we make the power sector in Nigeria work? Some of those challenges include infrastructure deficiencies. If we think about it, like I had mentioned earlier, 18,000 megawatts as our generation capacity, yet we can only produce or generate 5,000 to 4,000. Our infrastructure is outdated. It's in urgent need of modernization. And this results in frequent failures and maintenance issues. Our people, sadly, some of our people consider electricity as their God-given right and not a service they have to pay for. Until we develop laws that ensure that citizens who steal electricity are accountable for it, we'll continue to see illiquidity in the sector. Another thing that we face is the dependency on natural gas. Many Nigerian power plants rely on natural gas, and we all know the stories around the vandalisms of pipelines and other operational inefficiencies. And all of these create major bottlenecks in the supply chain for our power plants. There are also those financial constraints because what has simply happened is that there's a significant gap between the cost of electricity production and the revenue that's generated. Remember, I had said some people steal electricity, so even being able to recoup the cost is quite difficult. And so the tariffs themselves cannot cover the cost of producing electricity. There are some regulatory and institutional challenges, although Nigeria has introduced reforms like the tariff adjustments. Implementing these still remain a challenge. We would need stronger governance and regulatory frameworks to make this work. So is all hope lost? No. Despite these challenges, Nigeria is making progress. Just recently, the NEC announced that Nigeria has set a new power generation record of about 5.3 megawatts. The government has also made plans to invest about $800 million to further develop the sector. There have been some international partnerships, particularly the ones with Chinese firms to supply 1.4 million electricity meters, and there have been a number of MOUs that are focused on renewable energy. So those are some of the good things that have happened. We've also received significant support from international financial institutions. So, for example, the World Bank has restructured a $350 million loan for 7 power plants. The African Development Bank has approved $500 million for a new energy program and a $1 billion fund for sector reforms. We've also made some progress in metering and infrastructure. So Nigeria, the federal government, has allocated about 21 billion naira for prepaid meters, and USAID has mobilized about $245 billion for infrastructure and renewable projects. NERC has recently approved 8.1% tariff cut for Band A customers, and they've also unbundled the Transmission Company of Nigeria, that's the TCN. Gerigu Power and Siemens Energy are currently upgrading the Gerigu power plant, while BAT Nigeria has recently inaugurated a solar power plant in Ibadan. So what do we have to look forward to? There's very cautious I would say there's cautious optimism for the sector's future. Until there's enough capital, we'll continue to see a proliferation of off-grid solutions such as renewables, low-capacity gas plants that are leveraging on CNG technology. All these solutions are currently being championed by the REN. We also hope that the mindset of our people will change such that they start to pay for electricity rather than steal it. I know some years back in India, they had experienced the same thing, and the government had to introduce very strong punitive measures for those who stole electricity. And so that has significantly reduced there. So until our government shows the will to do the same here in Nigeria, we may have a challenge there. But looking forward, we expect to see more positive things coming through from there. And in conclusion, I mean, really, while Nigeria's power sector faces significant hurdles, there are a number of recent developments and ongoing investments that give us hope. We hope that they're able to lay a strong foundation for future growth and provide more reliable and efficient power in Nigeria.
As the U.S. Federal Reserve Policy Committee decides this week on how much to cut rates, many analysts expect that the uncertainty on many geoeconomic parameters will lead to more caution to start on a measured note. Those calling for 25 basis points argue that the inflation battle is not yet won, given that services inflation remains high. Bank of Canada Governor Tim Malcolm over the weekend in an interview said he's not ruling out more cuts. The Bank of Canada had trimmed rates by 0.25 times in a row since June, bringing it down by 75 basis points to 4.25% earlier this month, as inflation in Canada in July fell to a 40-month low of 2.5%. As we get more cuts to rates, how will all this affect emerging economies, especially Africa? We repeat our chat that we did last week where we looked at some of the implications. As Western economies cut rates, the monetary climate all over the world will see some relief. According to a recent report by the IMF, the era of tightening resulted in a sharp slowdown of Eurobond net issuance by emerging market and developing economies, down 70% relative to the prior 2 years. Also, the tightening led to net Eurobond outflows totaling about $58 billion due to maturing Eurobonds exceeding abating new issuance. As rates become more affordable for net borrowers, there is already a recovery in Eurobond issuance to the tune of about $40 billion in the first quarter of 2024, as countries such as Benin and Cote d'Ivoire return to the market. The onset of a Fed easing cycle supports an additional rebound in Eurobond issuance and a broader revival of capital flows to emerging markets and developing economies, and of course increased dollar-denominated debt volumes. Lower interest rates create the opportunity for debt-burdened EM, that's emerging markets, to refinance more expensive borrowings to reduce their debt servicing costs. As appetite for EM assets is revived and capital flows back, it's an opportunity for Africa to strategize afresh, not misusing this opportunity by ushering a new phase of profligacy. Priority should be given to technology infrastructure, education and health, on getting the basics right and repairing foundations. Both recurrent and capital expenditures have to be comprehensively re-examined. New paradigms for governance are needed to get better value and improved productivity. We should have learned from the tough era of tightening what we really do not need and what we must have. We just saw a stampede into Nigeria's first local dollar bond, massively oversubscribed. Access to foreign capital is less the issue. The bigger challenge has always been judicious spending, discipline, and project conceptualization, and plugging leakages, reviving productivity by cutting waste and killing the monster of corruption. European stocks were mixed as investors braced for a busy week of interest rate decisions from the US Federal Reserve, Bank of England, and Bank of Japan. US stocks opened mostly flat, slightly lower as a decision by the Federal Reserve FOMC looms. Well, that's it from me on Global Business Insights. Thanks for watching. Bye-bye.